Did you know that a small group of people you've never met determines whether you can afford a home? Every time the Federal Reserve changes interest rates, they're silently taking money from your pocket, and you probably don't even realize it. In 2021, the average mortgage rate was under 3%. Today, it's over 6%. On a $400,000 home, that's an extra $700 every month, money that could have been yours. And that's just the beginning of how the Fed controls your financial future. The invisible tax, how interest rates drain your wallet. Isn't it strange that nobody voted for this financial drain on your bank account? Think about it. There's a hidden force that's silently pulling money from your wallet every single month, and you never had any say in the matter. I'm talking about interest rates, the invisible tax that's affecting every aspect of your financial life. When the Federal Reserve raises interest rates, they're essentially making money more expensive for everyone. It's like a tax that nobody authorized, yet we all have to pay. And unlike actual taxes, there's no public vote, no debate in Congress. Just a group of people in a room making decisions that directly impact how much money stays in your pocket. Since 2022, when rates began their dramatic climb from near zero to today's 5.5%, the average American has experienced a shocking loss in purchasing power. Let me show you what this means in real dollars. Take a family with a $5,000 credit card balance, a pretty common situation for many households. In 2021, they might have been paying around 16% interest, costing them about $800 annually. Today, that same balance at current rates of around 22% costs them over $1,200 per year. That's an extra $400 going straight to the banks, money that could have covered a month's worth of groceries or utility bills. But here's the thing, this interest rate hike doesn't just hit your credit cards. It's a simultaneous attack on your entire financial life. Your mortgage, car loan, student loans, personal loans, they're all affected at once. Imagine a boxer taking hits from not just one opponent, but 5 different directions at the same time. That's what rising interest rates do to your finances. Let's break down how this plays out in real life. Housing affordability has plummeted. A house that would have cost you $1,500 monthly in mortgage payments at 3% interest now costs over $2,200 at 7%. For the exact same home, many people who could comfortably afford to buy a home 2 years ago are now completely priced out of the market. Car loans tell a similar story. The average new car loan rate has jumped from about 4% to over 7% since 2021. On a $35,000 car loan, that's an extra $3,000 in interest over the life of a 5-year loan. That's $3,000 you're paying for exactly the same car, just because you bought it after rates increased. Even everyday purchases take a hit when you consider how many Americans rely on credit for basic necessities. A recent survey found that 45% of Americans carry credit card balances month to month, with inflation forcing many to use plastic just to cover essential expenses like groceries and gas. As interest compounds on these necessary purchases, households find themselves in an increasingly difficult position. Let me paint a picture of what this means for a typical middle-class family. Before the pandemic, a household earning $75,000 might have had a $250,000 mortgage at 3.5%, a $25,000 car loan at 4%, and $4,000 in credit card debt at 16%. Their monthly obligation for just the interest on these debts would have been around $900. Fast forward to today. That same family, with the same loans at current rates, would be paying about $1,350 monthly in interest alone. That's $450 more every single month, or $5,400 per year, without getting anything additional in return. It's like someone sneaking into your home and taking $450 from your wallet every month. But wait, some people might argue, what about savers? Don't they benefit from higher interest rates? Well, yes and no. While savings account rates have increased, they haven't kept pace with lending rates. Major banks were quick to raise the rates they charge borrowers, but dragged their feet on increasing what they pay savers. Even today, when the Fed rate is 5.5%, many traditional savings accounts at major banks pay less than 0.5% interest. The banks pocket that massive difference. This creates a system where those who are already financially secure, with money to save and no debt, fare much better than those struggling with debt or trying to make major life purchases. The interest rate gap becomes a wealth gap accelerator, making economic inequality worse. So why does this system exist? Who actually benefits from it? These questions lead us to some uncomfortable truths about our financial system. Banks and financial institutions are reporting record profits during this high-interest environment. In 2023 alone, U.S. banks made over $280 billion in profits, with a significant portion coming directly from interest income. The difference between what they pay depositors and what they charge borrowers. The figures are staggering when you consider the collective impact. How much money is the Fed actually taking from your wallet right now? The average household is losing between $3,500 and $5,000 annually through higher borrowing costs compared to 2021. Multiply that by the roughly 130 million households in America. And we're talking about hundreds of billions of dollars being transferred from everyday Americans to financial institutions each year. This isn't just affecting individual purchases or financial decisions. It's reshaping entire life trajectories. Young adults are delaying homeownership, putting off starting families, and carrying student loan debt longer because of these higher rates. Retirement savings are being reduced as more income goes towards servicing debt. The compounding effect of these changes will be felt for decades. What makes this particularly frustrating is how little control most people have over it. You can be doing everything right financially, working hard, trying to save, making responsible choices, and still find yourself falling behind because of interest rate decisions made in boardrooms you'll never enter. The consequences extend beyond just the numbers in your bank account. Financial stress from increased debt burdens leads to real health impacts. Studies have linked financial stress to higher rates of anxiety, depression, sleep disorders, and even physical health problems like high blood pressure and heart disease. The true cost of high interest rates includes not just dollars and cents, but quality of life as well. And here's another concerning aspect. Unlike other economic factors, interest rates affect nearly everyone, regardless of whether they even understand how the system works. Many Americans don't fully comprehend how Federal Reserve decisions impact their daily lives, which means they can't effectively plan for or respond to these changes. It's like playing a game where you don't know the rules, but you're still expected to pay the penalties. Meet your financial puppet masters inside the Federal Reserve. You're playing a high-stakes financial game where you don't know the rules, and the referees are working for the opposing team. That game with hidden rules I mentioned? It's controlled by just 12 people you've probably never heard of. When Federal Reserve Chair Jerome Powell casually mentions they do not need to be in a hurry to change rates, your mortgage payment stays higher for months longer, your credit card debt keeps growing, and someone's dream of homeownership gets postponed another year. So who exactly are these mystery people with their hands on the financial puppet strings of America? Meet the Federal Open Market Committee, or FOMC, a small group of just 12 individuals who make decisions affecting trillions of dollars in the economy. This elite financial club consists of the 7 members of the Federal Reserve Board of Governors, plus 5 of the 12 Federal Reserve Bank presidents who rotate through voting positions. That's right, just a dozen people in a boardroom can alter your financial future with a single vote. What's most shocking is the contrast between their immense power and how little most Americans know about them. These aren't elected officials who campaigned for your vote. You didn't interview them for the job of controlling your financial destiny. Yet their decisions ripple through every aspect of your economic life, from how much your paycheck is worth to whether you can afford a home. The Fed operates under what's called a dual mandate from Congress: maintain price stability and maximize employment. Sounds reasonable, right? But here's where things get interesting. They use interest rates as their primary tool to achieve these goals. When they feel the economy is overheating and prices are rising too quickly, they raise rates to make borrowing more expensive, hoping to slow down spending and cool inflation. When they want to stimulate economic growth, they lower rates to encourage borrowing and spending. The real power of the FOMC lies not just in their actions, but in their words. The committee communicates through carefully crafted public statements and press conferences designed to enhance what they call transparency and accountability. But these communications are so powerful that markets can swing by hundreds of billions of dollars within minutes of their release. A single phrase in Powell's speech can send stocks soaring or crashing as investors frantically interpret what it might mean for future policy. Picture this. a group of suit-wearing economists sitting around a massive wooden table, discussing economic models and projections while the financial world holds its breath. When they emerge from their meeting, their announcement doesn't just change numbers on a screen, it changes lives. That's because the federal funds rate they control acts as the master rate in the economy, the benchmark that influences virtually all other interest rates. Banks use this rate when lending to each other overnight, but its influence extends far beyond that. When the FOMC raises this rate, banks quickly pass those increases along to consumers through higher credit card rates, mortgage rates, auto loan rates, and business loan rates. It's like a domino effect that eventually reaches your wallet. What's particularly troubling is the disconnect between the economic models Fed officials use and the financial realities everyday Americans face. While FOMC members debate decimal points and technical details like terminal rates and neutral policy, regular people are trying to figure out how to make their mortgage payments or save for retirement in this high-rate environment. These Fed officials aren't evil masterminds twirling their mustaches. Most genuinely believe they're serving the greater economic good, but they operate in a world far removed from typical financial struggles. The median net worth of Federal Reserve Board members is estimated to be in the millions, and many have spent their careers in academia, banking, or government, not worrying about making rent payments or stretching a grocery budget during inflation. So how exactly does a seemingly small change in the Fed funds rate translate to thousands of dollars coming out of your pocket? Through a powerful cascading effect. Each 0.25% Fed increase ripples through the economy, eventually hitting you from multiple directions simultaneously. When you add up all the impacts, from your mortgage to your credit cards to your car loans and beyond, a 1% rate increase ends up costing the average household between $800 and $1,200 annually. That's right, these 12 people you didn't elect and probably can't name have the power to drain roughly $1,000 from your household budget for every percentage point they raise rates. And they've raised rates by over 5 percentage points since 2022. What makes this even more frustrating is that these rate increases don't affect everyone equally. If you're wealthy with minimal debt and substantial cash savings, higher rates might actually benefit you through better returns on your money market accounts and CDs. But if you're a working class or middle class family with a mortgage and some credit card debt, these rate hikes hit you much harder. The FOMC's decisions also create winners and losers across different economic sectors. Higher rates tend to punish growth-oriented industries like technology and reward more stable sectors like utilities. They make life harder for first-time homebuyers, but may benefit retirees living off fixed-income investments. This uneven impact is rarely discussed when the Fed makes its announcements. And here's something else that should make you raise an eyebrow. The FOMC keeps their deliberations somewhat secretive. While they've increased transparency over the years, they still only release edited minutes of their meetings 3 weeks after they occur, and full transcripts remain sealed for 5 years. What are they discussing that we can't know about until 5 years later? Perhaps most concerning is how markets hang on every word from Fed officials, especially the chair. When Powell recently stated that they do not need to be in a hurry and are well positioned to wait for greater clarity regarding rate cuts, markets immediately adjusted their expectations. This communication strategy gives enormous power to the careful wording choices of just a few individuals. Think about it. When was the last time you heard a detailed explanation of how the Fed actually works? Our educational system rarely teaches these financial mechanics, leaving most Americans in the dark about one of the most powerful forces shaping their economic lives. It's like playing a game where you're penalized for breaking rules nobody ever explained to you. What's happening is a massive transfer of wealth through interest payments, from everyday Americans to financial institutions, orchestrated by monetary policy decisions that few people understand. The Fed didn't create this system, Congress established it. But the current arrangement concentrates enormous financial power in very few hands, with limited direct accountability to the public. The mortgage rate mystery. Why your dream home keeps getting more expensive. This massive wealth transfer becomes painfully personal when you're trying to buy a home. Think the Fed lowering rates means your mortgage will get cheaper? Think again. There's a shocking disconnect between what the Fed does and what happens to your mortgage rate. One that's costing you hundreds of dollars every month and keeping millions trapped in the rental market. Have you noticed that mortgage rates aren't dropping even when the Fed starts cutting. In fact, something bizarre happened in 2024. Mortgage rates actually increased during a period when the Fed began easing its policy. But why? Here's what your financial advisor probably isn't telling you. Mortgage rates have surprisingly little to do with the Fed's decisions. Instead, they're intimately tied to something called the 10-year Treasury yield. This connection explains why your dream home keeps getting more expensive even when headlines trumpet Fed cuts rates. When you apply for a mortgage, lenders aren't primarily concerned with what the Fed did last week. They're looking at where the economy might be heading over the next decade. The 10-year Treasury serves as the benchmark because most homeowners either sell or refinance within that time frame. If investors expect inflation or economic turbulence in the future, those Treasury yields rise, and your mortgage rate follows, regardless of what the Fed is doing with short-term rates. This is why you can have the puzzling situation where the Fed starts cutting rates, but your mortgage costs still climb. Banks are pricing in future economic uncertainty, not just current conditions. But that's only part of the story. Behind the scenes, banks have been quietly increasing their profit margins on mortgages since 2021. When lending in a high-inflation environment, financial institutions demand bigger cushions to offset their risks. This means they're keeping rates higher than necessary, padding their profits while you struggle to afford a home. The real-world impact is devastating. Let's put this in perspective. A $400,000 home with a 3% mortgage, common just a few years ago, would cost you about $1,686 monthly. That same home at today's 7% rates, you're paying $2,661 per month. Nearly $1,000 more every single month for the exact same house. That's an extra $12,000 per year just vanishing from your bank account. Money that could be building your wealth or improving your quality of life is instead flowing directly to financial institutions. But the tragedy extends beyond your monthly payment. There's a hidden phenomenon reshaping the entire housing market called the lock-in effect. Millions of homeowners are sitting on mortgages with rates around 3 to 4%. If they sell to upgrade or relocate, they'd be forced to take on a new loan at 7%. The math simply doesn't work, so they stay put. This creates a housing market standstill. Inventory remains critically low because existing homeowners refuse to sell. With fewer homes available, prices get pushed even higher despite the affordability crisis. It's a vicious cycle that particularly hurts one group: first-time homebuyers. The statistics tell a heartbreaking story. The share of first-time homebuyers has plummeted to just 24% in 2024, the lowest level since 1981. Before the 2008 financial crisis, that number typically hovered around 40%. Nearly half of the people who would normally be buying their first homes are now completely priced out of the market. This isn't just a temporary blip. We're witnessing a fundamental shift in who can access homeownership in America. The primary vehicle for middle-class wealth building is becoming increasingly exclusive, reserved for those who already have substantial assets or family support. For millennials and Gen Z, the American dream is morphing into the American mirage, always visible on the horizon, but somehow never getting closer despite working harder and earning more. So will mortgage rates ever return to the 3% range we saw during the pandemic? The uncomfortable truth is probably not anytime soon. Even when the Fed eventually cuts rates more aggressively, mortgage rates are likely to remain elevated compared to historical standards. Why? Because lenders have discovered they can maintain wider profit margins without losing too much business. The supply-demand imbalance in housing means they don't have to compete as aggressively on rates. Additionally, the economic fundamentals that produce those ultra-low rates, a pandemic-induced recession combined with massive government intervention, were extraordinary circumstances unlikely to repeat. The most revealing aspect of this mortgage rate mystery is how it exposes the limits of the Fed's power. Despite being portrayed as all-powerful economic puppeteers, the Fed can't directly control the rates most important to average Americans. They influence short-term borrowing costs, but long-term rates like mortgages follow their own path, guided by market expectations about inflation, economic growth, and global investment flows. This disconnect creates a persistent problem. The Fed might cut rates to stimulate the economy, but if those cuts don't translate to lower mortgage rates, they fail to revive the housing market, a crucial sector for economic growth. It's like stepping on the gas pedal, but finding your car stuck in neutral. What's worse, This mortgage rate situation disproportionately impacts middle and working-class families. Wealthy individuals can often purchase homes with cash or larger down payments, minimizing the impact of higher rates. For everyone else, each percentage point increase in mortgage rates diminishes purchasing power by roughly 10%. Just consider what that means in real terms. If you could afford a $500,000 home when rates were 3%, you can now only afford a $350,000 home at 7% with the same monthly payment. In many markets, that $350,000 doesn't buy much, forcing families to either overextend themselves financially or remain renters indefinitely. This reality represents one of the most significant wealth transfers in recent history. Young families who should be building equity through homeownership are instead paying inflated rents, while established homeowners and investors benefit from appreciating property values and rental income. Even when some relief in mortgage rates eventually arrives, the damage done will have lasting consequences. Years of delayed homeownership means years of missed equity building. A generation that buys homes at 35 instead of 25 has a decade less to build wealth through property appreciation and will carry mortgage debt later into their retirement years. The most frustrating part? This isn't simply the result of natural market forces. It's a financial system designed to favor certain participants over others, with everyday Americans consistently finding themselves at a disadvantage. The complex relationship between Treasury yields, lender profit margins, and mortgage rates operates in a way that maximizes profits for the credit card trap. How banks get richer while you get poorer. The plastic in your wallet is hiding a shocking secret. While the financial system doesn't just disadvantage homebuyers, it's rigged to extract wealth through every transaction you make. Americans now carry over $1.1 trillion in credit card debt, with the average person shouldering $6,365 worth. But here's the question nobody's asking. Why do your credit card rates skyrocket the moment the Fed raises rates, yet barely budge when rates are cut? The numbers tell a disturbing story. Credit card interest rates have exploded from an average of 16% to over 22% in just 3 years. That's nearly a 50% increase that's silently draining your bank account every month. And in 2024, the average APR on credit cards is projected to hit 24.43%, a level that would have been considered predatory lending not long ago. But the real scandal isn't just the high rates. It's the speed at which banks implement changes. When the Federal Reserve announces a rate hike, your credit card company wastes no time. Often within just one billing cycle, that increase gets passed straight to you. But when rates come down, suddenly the banks move at a glacial pace, holding on to those higher rates for as long as possible. This one-way timing mechanism creates a massively profitable asymmetry for banks. The math is simple. They cash in quickly when rates rise, but drag their feet when it's time to give consumers relief. This isn't accidental, it's by design. Credit card companies maximize profits by rapidly adjusting upward, but slowly adjusting downward. Let's break down what this means for your money. With the average American carrying $6,365 in credit card debt at today's rates, the interest burden is crushing. At 24.43%, that average balance generates over $1,550 in annual interest. Money that simply vanishes from your finances without paying down a single dollar of what you actually spent. The situation gets even worse when you look at minimum payments. Credit card companies typically set minimum payments that barely cover the interest accruing each month. Take a $5,000 balance at 22% interest. The monthly interest alone is about $91. If your minimum payment is only $100, you're making just $9 of progress on your actual debt. At that rate, it would take decades to pay off the balance, all while the bank collects thousands in interest. This system creates a perfect trap. As interest rates climb, minimum payments cover less and less of your principal. Many Americans find themselves making payments month after month while watching their balances stay virtually the same. It's like running on a financial treadmill that keeps getting steeper. The connection to Fed policy is direct but deliberately obscured. Most credit card APRs are calculated based on the prime rate, which is the Federal Reserve rate plus 3%, plus an additional margin set by the card issuer. Traditionally, if the prime rate was 8%, your card might charge prime plus 10%, giving you an 18% APR. But here's where banks have gotten even greedier. During the recent inflation period, many issuers widened this spread, increasing their markup over the prime rate. So even as the Fed rate increased, banks added their own extra increases on top. This is why your credit card rate probably jumped more than the actual Fed rate increase. The consequences are starting to show. Credit card delinquency rates have been rising, with a serious delinquency rate of 7.1% reported in Q3 2024. This means more people are falling 90-plus days behind on payments, a clear sign that the system is pushing consumers beyond their financial breaking point. What makes this especially painful is the timing. Credit card debt has become a necessity for many Americans just trying to make ends meet. With inflation driving up costs for basic necessities like groceries and utilities, millions have turned to credit cards not for luxuries, but for survival. They're now paying astronomical interest rates on essential purchases like food and medicine. This reality creates a vicious cycle. High interest rates make it harder to pay down balances, which leads to more interest being charged, which makes it even harder to pay down balances. The math becomes impossible for many households, especially those on fixed or limited incomes. And unlike mortgages, which at least build equity in an asset that typically appreciates, credit card debt is entirely extractive. There's no underlying asset gaining value. It's purely a financial drain that transfers money from consumers to financial institutions. The industry defends these practices by pointing to risk. Credit card debt is unsecured, they argue, which justifies higher rates to cover potential defaults. But this explanation falls flat when you look at bank profits. Major credit card issuers have reported record profits in recent years, clearly indicating that current rates far exceed what's needed to cover the actual risk. Some consumers have found temporary relief through balance transfer offers, promotional deals that let you move debt to a new card with 0% interest for a limited time. But these offers typically come with fees of 3 to 5% of the transferred amount, and the fine print often includes traps that can result in retroactive interest charges if you miss a payment or don't pay off the full amount during the promotional period. What's particularly infuriating is how little transparency exists around these practices. Most consumers have no idea how their credit card rates are determined or why they change. The cardholder agreements that explain these details are written in dense legal language, specifically designed to be difficult to understand. This asymmetry of information gives banks an enormous advantage. They know exactly how the system works and how to maximize profits, while consumers are left in the dark, often discovering rate increases only when they receive their monthly statements. The problem is compounded by the fact that many Americans are financially trapped by their credit score. If you've built up significant credit card debt and your score has dropped as a result, you may not qualify for better cards with lower rates. This creates a situation where those who most need relief from high rates are the least able to access it. For those trying to escape this trap, the path is challenging but not impossible. Focusing on paying more than the minimum, even just a little more, can dramatically reduce the time and total interest paid. Prioritizing high-interest debt first, the avalanche method, minimizes the total interest burden, while some find psychological momentum by paying off smaller balances first, the snowball method. But these individual strategies, while helpful, don't address the fundamental inequity of a system that's structured to benefit financial institutions at the expense of consumers. The credit card market operates with built-in asymmetries that systematically disadvantage cardholders. Industry advocates often suggest that consumers simply need more financial education. While financial literacy is valuable, this argument shifts responsibility away from the institutions that design these complex, consumer-unfriendly products in the first place. Even financially savvy consumers find themselves at a disadvantage in a system where the rules can change at any time with minimal notice. The savings account scam. Why your bank is keeping your money. Financial literacy won't protect you from what's happening to your savings account right now. While we've been conditioned to focus on the dangers of debt, there's a quieter financial trap that's been draining your wealth all along. Traditional banks are paying you pennies on your hard-earned savings, less than 0.41% interest on average, while the Federal Reserve rate sits at 5.5%. That's not just a gap, it's a massive financial disconnect that's systematically transferring your money into bank profits. Let's put this in perspective. For every $10,000 you've parked in your traditional bank savings account, you're earning about $41 a year. That same $10,000 in a high-yield savings account offering 4% would generate approximately $400 annually. The difference? A whopping $359 that should be in your pocket, but isn't. This isn't some small rounding error. It's a deliberate business strategy. Think about how quickly your bank notifies you when they're raising rates on your credit card or adjusting your mortgage. Yet when the Fed raises interest rates, these same institutions move at a glacial pace to increase what they pay you on your savings. Sometimes they don't move at all. Since the pandemic, this disparity between what banks charge borrowers and what they pay savers has widened dramatically. While they've been quick to capitalize on higher lending rates, they've dragged their feet when it comes to passing those benefits on to you as a saver. In banking terms, this is called increasing the spread, the difference between what they pay for money and what they charge to lend it out. But in everyday terms, we should call it what it really is, a transfer of wealth from you to them. The numbers are shocking when you break them down. Let's say you're being financially responsible and keeping a $25,000 emergency fund in your traditional bank. At the current average rate of 0.41%, you'll earn about $103 in a year. If you move that money to a high-yield savings account offering 4%, you'd make $1,000 instead. That's an extra $897 annually. Money that could cover a car payment, several grocery runs, or boost your retirement savings. Online banks can offer these higher returns because they don't have the overhead costs of physical branches. They don't need to maintain thousands of buildings, pay utilities, or staff brick-and-mortar locations. Those savings get passed on to you in the form of higher interest rates. Yet many Americans leave their money sitting in traditional banks out of habit, convenience, or simply not realizing how much money they're leaving on the table. What makes this situation even more frustrating is that these same traditional banks are borrowing money from the Federal Reserve at 5.5% and then turning around and paying you less than 1/10 of that on your deposits. It's an incredibly profitable arrangement for them. The Fed raises rates, banks immediately charge more on loans, but they're in no hurry to pay you more for the privilege of holding your money. This is particularly painful in our current economic environment. While inflation has cooled from its recent peaks, it still sits above the Fed's 2% target. This means your savings are losing purchasing power in two ways. First, through inflation eating away at your money's value, and second, through the opportunity cost of not earning competitive interest. It's a double penalty for those trying to be financially conservative. Conservative savers, often retirees or those approaching retirement, are hit hardest by this practice. These individuals typically keep larger amounts in cash because they can't risk market volatility with money they might need soon. The difference between 0.41% and 4% on a $100,000 retirement savings cushion is $3,590 annually. Essentially a part-time job's worth of income that's being forfeited to bank profits. You might wonder why banks can get away with this. The answer is simple. They're betting on your inertia. They know that switching banks feels complicated and time-consuming. They're counting on the fact that most people won't do the math on what they're losing or won't take action, even if they do understand. Plus, many consumers maintain relationships with their banks that span decades. There's a psychological barrier to leaving something familiar, even when it's costing you money. Large national banks have even less incentive to offer competitive rates because they have captive customer bases. Their convenient branch locations, established relationships, and integrated financial services create a sticky ecosystem that makes customers less likely to leave, even when offered better rates elsewhere. This allows them to maintain wider spreads between what they borrow at and what they pay depositors. The pandemic only worsened this situation. When the economy shut down in 2020, Americans dramatically increased their savings rates as spending opportunities disappeared and government stimulus arrived. Banks suddenly found themselves flush with deposits they didn't need to compete for. Even as rates have risen since then, many banks have kept their savings rates low because, bluntly, they can. What's particularly concerning is how the banking industry frames this issue. When questioned about low savings rates, industry representatives often talk about relationship banking and the value of branch access or other services. They'll suggest that the convenience of having all your accounts in one place is worth foregoing hundreds or thousands of dollars in interest. But would you pay a $500 annual fee just to walk into a branch occasionally? Because that's effectively what many consumers are doing. This isn't just happening with savings accounts. Money market accounts at traditional banks often pay similarly low rates, despite their names suggesting they might offer market-competitive returns. Certificate of deposit rates show the same pattern, dramatically lower at brick-and-mortar banks than at online institutions. It's worth noting that this problem isn't evenly distributed. Those with more financial knowledge and resources are already taking advantage of high-yield accounts, while those with less financial literacy, often those who can least afford to lose out on interest, are disproportionately affected by this gap. In this way, the savings rate disparity is actually widening economic inequality. The situation becomes even more troubling when you consider that many banks are sitting on your money and investing it in treasury bonds paying 4 to 5%, essentially earning that rate on your deposits while paying you a fraction of it. It's one of the easiest profit centers in the entire banking business. So what can you expect going forward? As the Fed begins to cut rates, high-yield savings accounts will likely lower their rates fairly quickly, since they compete actively on those numbers. Traditional banks, however, may keep their already low rates exactly where they are, maintaining or even widening the gap. The result? You'll lose out on even more potential interest as this spread persists. The 2025 rate cut forecast. Will relief finally come? Those persistent banking spreads aren't the only financial challenge on the horizon. What if I told you the Fed's planned rate cuts for 2025 won't actually make mortgages, car loans, or credit cards affordable again? While Wall Street celebrates each projected quarter-point cut, the real story behind these numbers reveals why we're stuck in a new era of higher costs, regardless of what the Fed does next. Let's talk about what economists are actually forecasting for 2025. Despite all the excitement about the Fed's pivot to cutting rates, the reality is much more sobering. Current projections show we're likely to see only 2 to 3 modest rate cuts next year, totaling around 0.75%. That's a far cry from the dramatic relief many Americans are hoping for. The uncomfortable truth is that these modest cuts won't bring rates anywhere close to the pre-pandemic levels many homebuyers and borrowers remember fondly. According to Morgan Stanley strategists, mortgage rates will likely remain stubbornly above 6% throughout all of 2025, still keeping many potential homebuyers on the sidelines. Think about what this means for your finances. Even if the Fed delivers on all projected cuts, the National Association of Realtors expects mortgage rates to average between 6.2% and 6.4% by the end of next year. These aren't temporary elevated rates. They represent a fundamental shift in our financial landscape. Why is the Fed being so cautious about cutting rates? The answer lies partly in inflation. While inflation has cooled significantly from its peak, it still remains above the Fed's 2% target. This persistent inflation pressure means the central bank can't afford to cut rates too quickly without risking another inflation spike. But there's another factor complicating the Fed's decisions: politics. The uncertainty surrounding the new administration's economic policies, particularly regarding tariffs, has the Fed proceeding with extra caution. Fed Chair Jerome Powell has explicitly stated that the Fed is not in a hurry to lower rates further, emphasizing the need for greater clarity on how these new policies might influence inflation. This cautious approach is a stark contrast to what many Americans are expecting. The Fed has actually revised its projection downward, now suggesting only 2 rate cuts in 2025 instead of the 4 they previously anticipated. That's nearly half the relief originally expected. Let's look at what this means for specific parts of your financial life. For mortgages, even with these modest cuts, Bankrate's 2025 interest rate forecast suggests financing costs across various products will remain elevated. The dream of 3% mortgage rates is firmly in the rearview mirror. Credit card rates tell a similar story. While we might see some minor decreases in credit card APRs as the Fed makes cuts, these rates started from such elevated levels that they'll remain historically high. TransUnion projects that credit card balance growth and delinquency rates will slow as inflation pressures dissipate and interest rates decline. But that's simply saying things won't get worse, not that they'll return to pre-pandemic affordability. What's particularly concerning is how this affects housing affordability. With mortgage rates projected to stay above 6%, the dream of homeownership remains out of reach for many Americans. especially first-time buyers. The housing market is experiencing a fundamental shift, not a temporary aberration that will soon correct itself. This is where historical patterns provide important context. After inflation spikes like the one we experienced, rates typically stay elevated for an extended period. The Fed's extremely cautious approach signals they intend to keep rates higher for longer to ensure inflation is truly under control before making significant cuts. What's behind this new normal of higher rates? It's a complex mix of factors that go well beyond the Fed's decisions. The structural changes in our economy, including significantly higher government debt, create upward pressure on interest rates that won't simply disappear with a few Fed cuts. These persistent higher rates reflect a fundamental reset in the risk premium lenders demand. During the decade of near-zero interest rates that followed the 2008 financial crisis, lending standards and risk assessments became exceptionally accommodative. That era is over, and lenders have permanently adjusted their models to account for higher inflation and economic volatility. This isn't just speculation. It's reflected in the spreads between Treasury yields and consumer rates. Banks and lenders have maintained wider profit margins even as the Fed has begun cutting rates. This suggests they've fundamentally reassessed the risks of lending and aren't planning to narrow these margins anytime soon. The new administration's policies could further complicate the picture. If proposed tariffs are implemented, they could create additional inflationary pressures, limiting the Fed's ability to cut rates aggressively. Powell has specifically cited these potential policy changes as a reason for caution, suggesting the Fed is waiting to see how these policies affect the economy before making more aggressive cuts. So what does all this mean for your personal financial planning? It means we need to adjust to a new reality where the cost of borrowing remains substantially higher than what we became accustomed to in the 2010s. The days of ultra-cheap money are behind us. This has profound implications for major life decisions. For homebuyers, it might mean adjusting expectations about what you can afford or considering alternative financing strategies. For those with credit card debt, it means the urgency of paying down those balances hasn't diminished, even with modest rate cuts on the horizon. The affordability challenges aren't going to magically disappear with a few Fed rate cuts. Morgan Stanley's analysis suggests that even with projected rate decreases, affordability isn't expected to return to pre-pandemic levels. This isn't a temporary storm to weather. It's a permanent shift in the financial landscape that requires new strategies and expectations. That said, there are some potential bright spots in the forecast. TransUnion projects that as inflation continues to cool and rates gradually decline, we should see some stabilization in consumer credit health. Serious delinquency rates for credit cards may begin to level off or improve slightly as the modest rate cuts provide some marginal relief. But the key word here is modest. The fundamental reset in interest rates means that even after all projected cuts in 2025, borrowing costs will remain dramatically higher than they were before the pandemic. This creates a new financial reality that economic different strategies for beyond your personal finances and managing debt. This new financial reality doesn't just impact your wallet. It's quietly undermining your job security too. While we've been focused on how interest rates affect our mortgages and credit cards, there's a much larger economic drama unfolding that could determine whether you'll even have a paycheck to cover those expenses. Your career stability might be hanging in the balance each time the Fed makes a decision. When interest rates climb, it's not just your personal finances that feel the squeeze. Businesses across the country face the same painful math problem. Their borrowing costs skyrocket. That manufacturing plant expansion that would have created 200 new jobs, it suddenly looks too expensive on paper. The tech startup that was planning to hire 50 programmers, they're now delaying growth plans until borrowing costs come down. This ripple effect is happening right under our noses. Companies don't usually send out press releases announcing, "We're not hiring because interest rates are too high." But the connection is very real. A fascinating study shows that a single percentage point increase in the federal funds rate can actually reduce GDP by about 0.4% over roughly a year and a half. That might sound small, but it translates to hundreds of thousands of jobs vanishing from the economy. Your own employment security is directly tied to these macro-level decisions. Think about it. When companies face higher borrowing costs, they don't just shrug and pay up. They make tough choices, delaying expansions, freezing hiring, limiting raises, or in worse cases, laying off workers. The real-world impact is that your next promotion, raise, or even your job itself might be silently affected by decisions made in those closed-door Fed meetings. The process economists call monetary policy transmission explains how this all unfolds. When the Fed adjusts that key rate, the effects don't happen instantly. They ripple through the economy like a stone thrown into a pond. First, banks adjust their prime rates. Then businesses recalculate their investment plans. Finally, those business decisions translate into real employment outcomes that affect your household income. Some industries get hit way harder than others when rates rise. Construction is usually first to feel the pain. When mortgage rates climb, housing demand falls, and builders put their hammers down. Manufacturing follows closely behind as factories delay expansions and equipment upgrades. Even the booming tech sector isn't immune. Those sky-high valuations that fueled hiring sprees depend heavily on cheap money. When that money gets expensive, the hiring freezes and layoffs we've seen rippling through Silicon Valley make perfect sense. This creates a troubling spiral that affects even workers who keep their jobs. When companies pull back on expansion, they're not creating new positions that would normally push wages higher through competition for talent. Your bargaining power shrinks. That big raise you were counting on, it might be a victim of Federal Reserve policy before salary discussions even begin. The data shows this happening in real time across the economy. Business investment in equipment and structures typically slows dramatically after interest rates rise. Companies become more cautious, preserving cash instead of investing in growth. They stretch existing resources, meaning you and your coworkers take on more responsibilities without additional compensation or help from new hires. Your retirement accounts aren't spared either. When interest rates rise, stock valuations tend to fall as investors shift money to safer interest-bearing investments. This creates a double whammy for workers. Your job security decreases while your 401k balance takes a hit at the same time. That retirement date you had circled might need to be pushed back. What's particularly frustrating is how these effects hit different workers unequally. If you're in an industry that's highly sensitive to interest rates, or if you work for a company that relies heavily on borrowed money for operations, your job security is far more vulnerable to Fed decisions. Meanwhile, workers in certain government positions or stable essential industries might barely notice the impact. And let's talk about timing. There's a critical lag between when the Fed makes changes and when the full effects hit the job market. The research shows it takes about 18 months for that 0.4% GDP reduction to fully materialize after a rate hike. This delayed impact creates a dangerous situation where the Fed might keep rates high based on current strong employment numbers, not realizing they've already set in motion forces that will hurt jobs months later. Think about what's happening right now. We're in the middle of this exact scenario. The Fed has kept rates high to fight inflation, but the full employment impact of those decisions is still working its way through the system. The job market might look stable on the surface, but underneath, businesses are making decisions that will affect hiring and wages well into next year. The most concerning part? Most workers have absolutely no idea this is happening. We see the direct hit to our mortgage or credit card statement, but few of us connect the dots to realize that same force is silently threatening our income. It's like having a second financial challenge hiding in plain sight. Some economists argue this is precisely the point, that the Fed intentionally slows hiring and wage growth to cool inflation. When workers have less bargaining power and consumers have less money to spend, prices tend to stabilize. But this approach treats employment as a sacrificial lamb in the fight against inflation, creating real hardship for families caught in the crossfire. For those working in vulnerable industries, the warning signs are often there if you know where to look. When your company suddenly freezes hiring for open positions, delays planned expansions, or becomes unusually focused on cost-cutting despite solid profits, there's a good chance interest rates are playing a role behind the scenes. Your company's debt structure also provides clues about your vulnerability. If your employer relies heavily on variable rate loans or needs to refinance significant debt soon, they're especially exposed to interest rate pressures. This isn't information typically shared with employees, but public companies disclose it in financial reports, and even at private companies, these financial strains often become visible through budget constraints and leadership discussions. This hidden threat to job security explains why the Fed is moving so cautiously with rate cuts. They're walking an incredibly difficult tightrope. Cut rates too quickly, and inflation might flare back up, forcing them to raise rates again later, creating even more severe economic whiplash. But move too slowly, and they risk unnecessarily sacrificing jobs and wage growth when inflation is already cooling. The sobering reality is that your employment future is being decided in part by how the Fed interprets complex economic signals. Their educated guesses about how much unemployment is needed to keep inflation in check directly impact whether your company expands or contracts, hires or fires, raises wages or freezes them. All of this creates a troubling catch, 22 for average workers. Higher rates are painful for your monthly budget, but the rapid cuts that might bring relief could destabilize the economy and threaten your job. It's like choosing between a slow financial drain and the risk of losing your income source entirely. Economic warning signs. How to read the Fed's tea leaves. That catch, 22 from the last section, feels impossible to escape, unless you learn to decode the secret language of economic indicators. Ever wonder how some investors seem to anticipate interest rate changes months before they happen? They're not psychic. They're simply reading the same warning signs the Fed watches before making decisions that impact your financial life. While most people are completely blindsided by Fed announcements, you can position yourself ahead of the curve by understanding exactly what signals to watch for. The Federal Reserve doesn't make decisions in a vacuum. They're constantly analyzing economic data that's publicly available to everyone. The difference between financial winners and losers often comes down to who's paying attention to these signals. Let's break down exactly how to read these economic tea leaves like a pro. The Fed's primary job is monitoring the economy's health through key indicators, with inflation and employment data at the top of their watch list. When you understand which numbers matter most to them, you can essentially peek over their shoulders as they formulate their next move. The employment report, released on the first Friday of each month, offers crucial insights into the Fed's thinking. When job growth starts to decline for multiple consecutive months, the Fed typically becomes concerned about economic slowdown. This often signals they're getting ready to cut rates to stimulate hiring. On the flip side, when unemployment drops too low and wages rise rapidly, they worry about inflation and consider rate hikes to cool things down. Inflation data, particularly the Consumer Price Index, CPI report, provides another critical signal. The Fed targets 2% inflation, so when you see 3 consecutive CPI reports coming in below expectations, that's a strong indicator that rate cuts may be on the horizon. The Fed wants to see a consistent pattern before acting, not just a one-month blip, which is why watching for 3 consecutive reports is key. Perhaps the most telling signal comes from the Fed's own communications. When Fed officials start using more dovish language in their speeches, terms like patient or data-dependent, they're often telegraphing a shift toward rate cuts. This language change typically precedes actual policy moves by several months, giving you a valuable window to adjust your financial strategy. One of the most powerful predictive tools is something called the dot plot, a chart released after Fed meetings that shows where each member of the Federal Open Market Committee expects interest rates to be in the coming years. Each dot represents one member's projection, giving you insight into their collective thinking about future rate movements. When you see a significant shift in these dots from one meeting to the next, it's a clear signal that the Fed's outlook has changed. The yield curve, which shows the difference between short-term and long-term Treasury rates, offers another predictive tool that few ordinary investors understand. Currently, short-term rates are higher than long-term rates, creating what economists call an inverted yield curve. This unusual situation often signals that investors expect the Fed to cut rates in the future. Historically, when this inversion occurs, it's frequently been followed by rate cuts within 6 to 12 months. What makes these signals so powerful is that they're hiding in plain sight, yet most people have no idea how to interpret them. Think about it. When the Fed announces a rate change, the news treats it like a surprise, but the reality is that their decisions were telegraphed months in advance through economic data and their own communications. Let me give you a real-world example. In late 2022, the Fed was aggressively raising rates to combat inflation. But by early 2023, certain economic indicators started shifting. Employment growth began moderating, inflation reports showed consistent deceleration, and Fed officials began using more cautious language in their speeches. Investors who recognized these signals correctly anticipated that the Fed would pause its rate hiking cycle by mid-2023, giving them months to position their finances accordingly. Now let's talk about specific language shifts in Fed communications that often precede policy changes. When you hear the Fed chair use phrases like, "We're approaching a restrictive stance," or "We'll be data-dependent moving forward," they're essentially signaling they're near the end of a rate hiking cycle. Similarly, when they start emphasizing concerns about economic growth rather than inflation, they're laying the groundwork for potential rate cuts. The power of understanding these signals extends beyond just being informed. It allows you to make strategic financial moves before everyone else catches on. Imagine refinancing your mortgage just before rates drop further, or locking in a high-yield CD before banks lower their savings rates. These proactive decisions can save or earn you thousands of dollars simply by acting a few months ahead of the crowd. So what are the 3 most reliable warning signs that signal it's time to change your financial strategy? First, watch for multiple consecutive months of declining job growth in the employment reports. This suggests economic weakness that will likely prompt the Fed to cut rates. Second, look for 3 consecutive CPI reports that come in below expectations, indicating inflation is under control and giving the Fed room to ease policy. And third, pay attention when Fed officials suddenly shift to more dovish language in their speeches, suggesting they're preparing to lower rates. When these 3 signals align, it's almost like having a financial crystal ball. You'll have valuable months to prepare before the Fed actually announces changes that impact your wallet. Most people react after Fed announcements when rates have already moved, but by then, the financial opportunity has largely passed. I want to emphasize that these signals aren't perfect predictors. Economic conditions can change rapidly, and the Fed can adjust course. But they've proven remarkably reliable over time, and understanding them puts you miles ahead of the average person who's simply reacting to headlines. What's fascinating is that the Fed itself wants you to understand these signals. They've become increasingly transparent about their decision-making process precisely because they want markets and consumers to anticipate their moves rather than be surprised by them. By learning to interpret these economic indicators, you're not gaming the system. You're using it exactly as designed. Financial shield, protecting your money from interest rate changes. With the Fed's playbook in hand, you're ready for the most critical step, turning prediction into profit. Did you know that a 1% drop in interest rates could save you over $40,000 on a typical mortgage? But timing these financial moves wrong could cost you thousands, which is why conventional advice about mortgages, credit cards, and savings accounts might actually be working against you. Here's the truth, most financial advice doesn't account for interest rate cycles. It treats rates as fixed variables instead of what they really are, moving targets that require different strategies depending on which way they're heading. The financial decisions that make sense during rising rates could be completely wrong when rates are falling. So let's break down exactly how to shield your money regardless of which direction rates move. Think of this as your financial playbook for any interest rate environment. Let's start with mortgages, likely your biggest monthly expense. In our current environment where rates are expected to drop, adjustable rate mortgages, ARMs, suddenly become a strategic option. ARMs typically start with lower rates compared to fixed-rate mortgages, which means lower initial payments. As rates fall, your ARM adjusts downward, automatically giving you the benefit of lower rates without the hassle and expense of refinancing. But there's a catch. ARMs come with risk if rates suddenly spike after your initial fixed period ends. That's why you need to match your mortgage strategy to your specific situation. Planning to stay in your home less than 7 years? An ARM could save you thousands. Planning to stay forever? A fixed rate provides certainty, but be ready to refinance when rates drop substantially. Speaking of refinancing, don't just follow the old 1% rule blindly. Financial experts recommend refinancing when you can secure a rate at least 1% lower than your current mortgage rate. But that's only part of the equation. You also need to calculate how long you'll stay in the home to ensure you'll recoup the closing costs. For a $400,000 mortgage, dropping your rate by 1% could save you around $4,000 annually. But if closing costs run $8,000, you'll need to stay at least 2 years to break even. For homebuyers waiting on the sidelines, consider this strategy. If you need to buy now but expect rates to fall, look into mortgage products with free or low-cost refinance options. Some lenders offer programs where they'll refinance your loan with minimal fees if rates drop within a certain time frame. Now let's tackle that plastic in your wallet. Credit card debt is where falling interest rates often take longest to benefit consumers, so you need to be proactive. Rather than waiting for rates to decrease, explore balance transfer credit cards offering 0% introductory APRs. These promotional offers can last up to 21 months, giving you a window to eliminate your debt without paying a single cent in interest. The key is having a concrete plan to pay off the balance before the promotional period ends. Divide your total balance by the number of months in your promotional period and make that your minimum monthly payment. Set calendar reminders for when the promotional rate expires. This isn't the time to let autopilot take over. For example, transferring a $6,000 balance to a card with an 18-month 0% offer would require payments of $334 per month to clear the debt before interest kicks in. Compare that to keeping the same balance on a card with 22% interest, where you'd pay over $1,300 in interest during the same period, even with the same monthly payment. But don't close your old credit cards after transferring the balance. That can hurt your credit score. Instead, keep them open with zero balance, which maintains your credit history length and keeps your utilization ratio low. While managing debt is crucial, don't overlook your emergency fund. Financial experts emphasize that maintaining a robust emergency fund is even more important in fluctuating interest environments. When rates are high, having cash reserves prevents you from resorting to expensive credit options for unexpected expenses. The traditional advice of keeping 3 to 6 months of expenses still applies, but where you keep it matters more than ever. With traditional banks still paying under 0.5% despite Fed rates at 5.5%, your emergency fund is actively losing value to inflation if it's sitting in a conventional savings account. High-yield savings accounts offering 4 to 5% should be your default option for emergency funds. For money you won't need immediately, consider short-term CDs or treasury bills that pay even higher rates. As rates begin to fall, lock in longer-term CDs to preserve higher yields, a strategy called CD laddering. For debt reduction beyond credit cards, prioritize paying down variable-rate debts first when rates are rising or stable. These include private student loans with variable rates, personal loans with adjustable terms, and home equity lines of credit. When rates are falling, maintain minimum payments on these while attacking fixed-rate debts that won't benefit from the decreasing rate environment. Let's talk timing for major purchases. For vehicles, the conventional wisdom is to secure financing before shopping. But in a falling rate environment, get pre-approved but continue shopping for better rates until the day you sign. Auto loan. Rates respond quickly to Fed cuts, so even a month's delay could save you significantly. For those juggling multiple financial priorities, here's a hierarchy based on the current projections of gradual rate decreases. First, eliminate high-interest credit card debt using balance transfers or consolidation loans. Second, ensure your emergency fund is in a high-yield account earning at least 4%. Third, position yourself for mortgage refinancing by improving your credit score and gathering documentation. Fourth, avoid locking in long-term fixed rates on cars or personal loans unless absolutely necessary. Fifth, if you have excess cash, consider Series I bonds which adjust with inflation but lock in higher rates. The most critical step is to negotiate with your creditors. Many consumers don't realize they can simply ask for lower rates. Research shows that individuals who request lower credit card interest rates are frequently successful in receiving reductions, which can significantly decrease interest payments over time. Here's what most financial advisors won't tell you. Banks value retention more than ever in competitive environments. When interest rates fall, financial institutions worry about losing customers to competitors. This gives you leverage. Call your credit card company and tell them you're considering transferring your balance to another card with a lower rate. You'd be surprised how often they'll offer a rate reduction to keep your business. Remember, financial institutions assume most people won't take action even when it's in their best interest. Their entire business model depends on your inertia. By simply being proactive and aware of rate changes, you're already ahead of 90% of consumers. The hidden truth: who really benefits from high interest rates? Those financial institutions aren't just waiting for your inaction, they're banking on it literally. While most Americans struggle with rising debt costs, there's a massive wealth transfer happening right under our noses. The credit card debt crisis, hitting $1.17 trillion in 2024, represents a staggering 33% jump since pre-pandemic times. But who's collecting all this extra interest? Let's follow the money trail to see who's really benefiting from today's high-rate environment. Behind every percentage point increase in your credit card statement lies a financial system designed to enrich certain players at your expense. When the Fed raises rates, banks immediately jack up what you pay on variable debt, but they're suspiciously slow to increase what they pay on your savings. This asymmetric response creates a profit goldmine for financial institutions. The banking industry's windfall from rising rates is nothing short of extraordinary. With the additional $130 billion annually flooding into bank coffers compared to 2021 levels, we're witnessing one of the largest upward wealth transfers in recent history. That breaks down to about $1,200 extra dollars coming directly from each credit card holder's pocket every year. Money that could have gone toward building your financial security instead of padding bank profits. What's particularly concerning is how this burden falls unevenly across demographic groups. Americans aged 40 to 49 shoulder the heaviest credit card debt load, averaging $7,600 per person. Meanwhile, younger adults between 18 to 26 carry significantly less, around $2,781 on average. This creates a situation where middle-aged Americans, often juggling mortgages, car payments, and children's education costs, are disproportionately funding the banking boom. This wealth extraction system operates with surgical precision. When the Fed raises rates to cool inflation, the immediate effect hits borrowers through higher monthly payments. But the benefits of higher rates flow primarily to three groups: banks, wealthy individuals, and large corporations. Let's break down how each group wins in this high-rate environment. Banks are the most obvious beneficiaries. They immediately increase the rates they charge on variable products like credit cards, home equity lines, and adjustable-rate mortgages. Meanwhile, they drag their feet raising the interest they pay on deposits. This expanding spread between what they pay out versus what they collect is essentially pure profit. Wealthy individuals also come out ahead. If you've got substantial cash reserves or conservative investments, higher interest environments actually boost your passive income. Someone with $500,000 in high-yield savings or money market accounts might earn $20,000 to $25,000 annually in today's environment, a significant jump from the near-zero returns of 2021. The wealthier you are, the more you benefit from rising rates, especially if you've already locked in fixed-rate debt or own your assets outright. Large corporations with strong balance sheets capitalize on economic slowdowns by acquiring struggling competitors at discount prices or using their cash reserves to earn substantial income while waiting for better investment opportunities. Some tech companies are sitting on cash hoards earning billions in interest alone. Meanwhile, everyday Americans face a much harsher reality. The serious delinquency rate for credit cards hit 7.1% in Q3 2024, signaling that more consumers simply cannot keep up with their payment obligations. As these delinquencies rise, banks respond by raising rates even higher on remaining customers to offset potential losses, creating a vicious cycle. The wealth gap expands further because lower-income households typically have higher debt-to-income ratios and fewer options to refinance or negotiate better terms. They're essentially trapped in a system where they're paying premium rates while watching their financial security erode payment by payment. This isn't just an economic issue. It's becoming a political flashpoint. Senators Bernie Sanders and Josh Hawley have proposed legislation to cap credit card interest rates at 10%, arguing that current rates are exploitative. Their bill represents a rare moment of bipartisan concern over the banking industry's outsized profits during a period of financial strain for average Americans. Industry experts predictably warn that such caps would restrict access to credit for millions of consumers. This argument follows a familiar pattern. Whenever regulation threatens bank profits, the industry raises the specter of reduced services to defend their practices. What they don't mention is how their record profits come directly from consumers' pockets during already challenging economic times. The Federal Reserve's monetary policy decisions create ripple effects that extend far beyond controlling inflation. Their rate increases have created a particularly challenging environment for variable rate borrowers, especially those with credit card debt. While the Fed's mandate focuses on broad economic stability, the practical outcome of their decisions has been a significant upward redistribution of wealth. Government policy consistently favors creditors over debtors in several ways. Tax codes provide numerous advantages to investment income. Bankruptcy laws have been tightened to make debt discharge more difficult, and financial literacy education remains woefully inadequate in most schools. The combined effect is a system where those with financial knowledge and capital accumulate more, while those without fall further behind. So how can you position yourself on the winning side of this equation? The answer lies in understanding that the system isn't changing anytime soon. Your best strategy is to recognize the rules of the game and adjust your financial approach accordingly. First, work aggressively to move from the debtor to the creditor side of the equation. Every dollar of high-interest debt you eliminate immediately yields a guaranteed return equal to your interest rate. Paying off a 24% credit card provides an instant 24% return on your money, far better than most investment opportunities. Second, be strategic about where you keep your savings. The gap between traditional banks paying 0.5% and high-yield accounts offering 4 to 5% represents one of the easiest financial wins available right now. Moving your emergency fund to a high-yield account isn't just about earning more. It's about not leaving money on the table that banks are happy to keep for themselves. Third, understand that financial systems are designed to extract maximum profit from inaction and ignorance. The banking industry thrives on consumer inertia, the tendency to keep paying high rates without shopping around or negotiating. Simply being aware of rate changes and taking proactive steps puts you ahead of 90% of consumers. So here's the truth. You might not control the Federal Reserve, but you're not powerless against their decisions. As we look ahead to 2025's potential rate cuts, now's the time to become proactive rather than reactive with your finances. Financial experts recommend shopping around for the best offers on everything from credit cards to mortgages while maintaining that all-important credit score. Don't wait for the Fed to make their move. Start paying down your variable rate debts now, build a solid emergency fund, and research refinancing options so you're ready when rates finally drop. Remember, the financial system isn't designed with your best interests at heart. It's engineered to benefit the institutions. Your mission: position yourself on the winning side of these inevitable cycles by making strategic moves before everyone else does. The Fed will continue making decisions based on economic indicators, not your personal situation. But with your new knowledge of how this system works,